What's going on, everyone? I am Charles Moon, the disciple of trend, and this is my podcast, Buy High, Sell Low. Just want to mention that stock and stock options trading does involve a substantial degree of risk and may not be suitable for all investors. Past performance is not necessarily indicative of future results.
Welcome, everyone. Podcast number three. Yeah, that's right. So, before I move further, I want to give you a heads up. Number 4, which is supposed to come out on Friday, is going to be delayed. I'm going to try and shoot one, try and have it out, but there's a chance that I may not get it out. I'm just kind of waiting to see how the markets are, so that may be delayed till next week. Unfortunately, I'm going to be in the West Coast, Los Angeles. Some sunshine and some LA barbecue, Korean barbecue, along with food, observatory, and maybe some drinks. We'll have to wait and see, right? We're on vacation. So let's talk about what's in the news and what's happening in the markets, because this is important. The market kind of came to a standstill towards the end of the week, a little risk off, if anything. Risk off meaning buyers taking profits, a little betting to the downside, but ultimately just no demand. It dried up pretty quick, and that's in anticipation of the FOMC meeting. Now, this is important. For those that don't know about the Fed meeting, it is on the 18th and the 19th, okay? So what the FOMC does is that they meet, and then they make a decisive decision based on the U.S. economy on whether to hike rates, which is what they've been doing here, or to potentially cut rates. Now, cutting rates is a big thing. You may have heard about it in the news for those that are uninformed, but those that are informed, just stick with me here. And this is a big reason as to why the NASDAQ made this type of move, where it went from 72.92 72.92 to 7,900. That's a big jump for the NASDAQ. This is one thing for the NASDAQ to do this kind of a move, maybe over a month and a half, a quarter. This happened in basically a week. A week of gains, just vertical, straight up, no problems. Because the market reacted and started trading like we were in what was called a ZIRP environment. ZIRP, again, is an acronym for Zero Interest Rate Policy. Basically, there's no charge to borrow money. The Fed just prints money, gives it to you if you want it, and then you just pay it back. No interest. Now, that's what they're doing right now, okay? Right now, it is cheap. It is cheap to borrow money. The effect is that what the FOMC's stance in regards to now cutting rates is to stimulate the economy again by making it cheaper to borrow money. It's already, in all things considered, right, the grand scheme of things, from where we were just a few decades ago to where we are now, it is considered extremely cheap, even after the Fed hiked rates. But as of right now, the consideration, the speculation by the market, what they're starting to price in is that the Fed is going to cut. They're going to cut the rate. And in fact, it's almost a probability. The markets have priced it in, and they're betting. Here, I'll pull this up really quick, guys and gals. This is on the CME Group's website. Okay, if you want to do a simple Google search, do FOMC future rate cut CBOT. All right, FOMC future rate cut CBOT. And then you'll be directed to this page. Right, there'll be a link, and then you'll see what the market is currently pricing in terms of probability. Now, to read this page, people will pull it up and be like, what does this mean? To read the page, you can see the current target is 2.25% to 2.5%. You can see right here, target rate 2.25%, 2.5%, and it's actually highlighted as current in parentheses. On the next meeting, the market is pricing an 80% chance the FOMC does nothing. For the June meeting, okay, on 19, 80% chance is being priced in. So there's just a small chance, all right, around a 19-20% chance that there is going to be a quarter rate cut. Now let's look at July. Currently, July is being priced in that there's a 15% chance that the FOMC remains at the current rate. There's a nearly 69% chance that it gets cut a quarter basis point. And there's a 15% chance that they'll even cut further to half a basis point or more. In essence, the market is pricing in that not only some sort of rate cut is going to happen, but the probability is around 85 to 84%. Now let's look at the September month meeting. They're already pricing in the fact that we are going to make a move. It's now down to 4.8% that the FOMC stays at its current levels. So basically, the market is saying by September, there's a 95% chance something is going to be done. And in fact, they're starting to price in a 10% move to 1.5%. That's pretty extraordinary, by the way. That's usually a one-time extreme cut, or that's the process of the second cut coming into play. In October, you could see we're down to 3% that they're going to remain stagnant. And the big pricing is now even at 1.25. So we're talking about a full basis point being cut by October, 4% chance. And then the last meeting of the year in December, we are down to 1.5%. So basically the market is saying we are for sure starting to price in the fact that we are going to see a rate cut, at least one. 98.5% chance, guys and gals. It's pretty significant. Now, I know there's no guarantees, there's no 100% mark, but that's pretty damn close. Now, we're talking about even pricing down to 1%. That's hyper aggressive. We're talking about at this point potentially 2 to 3 or 2 major extreme cuts. The likelihood is that the FOMC does make a quarter basis cut where they get it down to 2.25%, and then it's a wait and see type of play, right? It's a wait and see. Now, what are we waiting and seeing? It wouldn't be a surprise, okay, if the FOMC in this meeting gives guidance towards the following meeting. They say, well, if the economic conditions remain stagnant, if the economic data provided is showing a slowdown, then we likely may have to, right? It's always about language. It's always about certain words. So I don't know the precise words. I don't study the FOMC's language themselves, but they're going to have to actually give some sort of guidance that this is going to come. Then the market can react. Now, this is important because Monday and Tuesday, right? I'm recording this actually Sunday evening, late Sunday evening. When we wake up Monday, I wouldn't expect too much activity. If you watch Friday's actions, trading action, it was very quiet. There was very little participation. Volume count fell off a cliff. The first half hour, maybe an hour, and that might be giving it a lot of credit, was when we saw trading activity per se, high levels of trading activity. But after that, it's as if everybody shut off their computer on Wall Street and went home. And the only people that were playing was retail. And it just seems like the market is waiting to see what is going to happen. Now, here's a few factors you're going to have to consider and some outlines of scenarios that I want to talk about. Yeah, I have the NASDAQ up here. I'll kind of go over some technicals here in a moment. But scenario number one is going to be the most important. It's going to be what's considered the surprise. Remember, I'll pull this back down here, okay? We are pricing in an 80% certainty that the Fed is not going to do anything on this meeting. It would be considered a surprise because of the way the market has priced it in. An 80% probability that the Fed is going to stay where it currently is. So scenario number one is going to be if the Fed surprises and hits that 19.2% probability that they actually cut in this meeting. That would surprise Wall Street. That would surprise Wall Street in a very positive way, because if they feel that the Fed is making this move to stimulate the economy, yeah, maybe some pessimists will be out there saying, well, that's because we're going into a recession. It's really not. The Fed stance here, it's pretty, I don't want to say it's pretty transparent, but it seems transparent. And it seems the ideology of the Fed has swayed here with Powell. And that this may be a proactive move by the FOMC, or at least that's their excuse. It may be a proactive move, right, to not allow the economy to fall into recession. That the Fed is taking steps to ensure that this won't happen. Of course, nothing is 100% foolproof, but this is one of the measurements. It's just an excuse to bring buyers into the market. Let's be real. It's to prevent the markets from falling off like it did when it started unraveling last October, November into December, and really started in August, I believe. It started in August of last year, that shakeup and volatility at those highs. Yeah, it was that fast drop. Oh, it was early September. My apologies. But we had a little bit of shakeup in August. And then when that 50-day moving average gave way, and by the way, that was the first initial sign something was wrong. Because look at the collective support that was coming in at that particular indicator. And once it gave way, folks, it gave way. So there's some concerns, because we've seen the market start giving away. It's a whole different story, though. This isn't really based on economic data. This is the fallout, right? Economic data is the fallout from, the bantering between the United States and China, the tariff war, the trade war, two knuckleheads going at it. I get it. I understand it. I'm just generalizing. But the surprise, the intervention of the FOMC into the marketplace, especially if it's viewed as a very strong positive for the investor, has the ability to cause very dramatic movements in the markets, most notably up. And so if that is the precursor, if that scenario number one comes into play where there's a surprise in the markets, the next thought that comes into play is that, holy cow, the FOMC, if they're making a move now, basically is ensuring we're going to get a second rate cut. And now all of a sudden, the markets start pricing that in with the belief, and this is how we get things crazy, that a third rate cut could potentially come into play because of how early the FOMC decided to move. See, as we move further down, the calendar year, the less likely they're going to tack on multiple rate cuts. And so the earlier the Fed makes this move, the allotment it has for more rate cuts in the future for 2019. Now, if it spills over into 2020, the market doesn't care. It's about the proactive move that they're doing for this calendar year. And now I do want to say that this intervention, right, is in turn a byproduct of what has happened with the trade war, right? Because it's obviously weighing on both countries' economics data, and these data points have been pretty severe in terms of misses on both ends. Now, we've seen some beats, of course. We've seen some positive, numbers here and there, but this is why the Fed wants to step in, because they're afraid that this could be an ongoing issue, which in turn would have a potential devastating fallout the longer that it sustains. And of course, the longer that it sustains, the worse it's actually going to get between the working conversation between both political government groups, I guess. I don't know, both government groups. And because of that instance, right, that means tension builds and things get worse. And that's like when the wall gets built up. And that's when that wall gets strengthened. And that big divide gets wider and wider. And so what ends up happening in terms of the fallout is that now that divergence is going to spill over into the markets. And who it's going to affect is what's important. Who cares about the small cap tech companies that provide one single core, component of an iPhone? Who cares? They're not going to, no, I hate to say that. I feel bad for the investors, but they're not going to cause the downfall of the market. However, we know what could happen when Intel and Apple and all these other major cap names, ones that could literally lift and drop these major markets by themselves based on their weighting. What happens when those are the names that are going to feel the fallout? That's a major key, right? We always say, well, when one of these supply companies or one of these component companies start unrolling, it's a leading indicator for the major names. That hasn't always been the case here. Let's not just completely tie that. Is there some symmetry? Of course there's going to be some assimilation because of the ties within the companies. But that doesn't mean it's going to be a direct leading indicator. More than anything, it has to be one of those alarms that's ringing off in your head for you to be at least attentive of that particular name, whether you're looking to trade it or whether you're an investor in that name. Now, let's go back to scenarios, okay? So scenario number 1 outlined is if the FOMC actually makes a surprise and hikes a rate here, cuts the rate here. And then the progressive thought is the market is going to start pricing in the second cut, because that should happen because of this one happening so early. At the very worst, we should expect a cut by December. And again, if you actually just bookmark this and track this throughout the calendar year, it's going to be a great provider and guidance on how the market is actually looking at the FOMC and in turn the correlative behavior that we're seeing in stocks. I'm not asking people to, divest 20, 30, 40 hours a week into studying, but if you can't take 5 minutes to just, divulge yourself into some what I feel is extremely important information, you're not giving enough of a damn about your own money. Care about your money. You guys work so hard for it. Yes, people say don't put your money in the markets unless you're willing to lose it. I get that theory. That helps the mentality more. But what really is important as you move forward to maximize your opportunity is to give a damn about your money. Don't overmanage your position. Just be smart enough to not get rolled over because you weren't caring enough. You weren't attentive enough. Simple things like this, where if you take 5, maybe 10 minutes out of your week, not your day, your week, to look at. And people will say, yes, I forget. I get that. Make it habitual. Give a damn. So let's outline scenario number 2, because if 1 comes into play, we know the market is going to rocket. They're going to price in a second one with the ideology of 3. Scenario number 2 is where we get back here, and I'll pull this back down, where we get the expectations. We get that 80%. So what does that mean for the markets? More likely than anything, the markets either remain stagnant or they go risk off. They haven't seen a reason to put risk on yet. Now, again, the one key variable here is the language that's going to be released. I'm not sure if there's going to be a press conference. I hope there is, because if there's a press conference, we could hear it direct from Powell's mouth. But more than anything, we're probably just going to get notes, a press release, and then, of course, we'll have the FOMC meeting notes released in July. But this is important here, guys and gals, okay? Because if there's any deviation in language, if they give guidance towards what their actions are going to be, and if they're hinting at rate cuts, right? That change in language, that change in stance, that change in how they're perceiving and looking to go moving forward. If it's data dependent, which they usually say they are, but let's be realistic about this. If that's going to be the case, that means that these consumer reports, these CPI reports, all these reports that come out, these job reports, NFP, non-farm payroll, these are going to be important. These are going to be important because the results of these reports could be giving us early guidance on how the Fed has to act. So that means the market is going to be very attentive of every piece of news that comes out there, and it's going to be very reactionary. And so scenario number 2 is going to be different from scenario number 1. Scenario number 1 is going to lead to probably movement more like this. Sharp jumps, pretty quick drops with an immediate grind back up, with news sprinkled in between to cause these drops. But because we're going to be trading in a rate cut environment with a potential hyper aggressive rate cut environment, bulls are going to be buying in on these dips. But scenario number 2 makes the markets a little bit more hypersensitive to the actual economic data, more hypersensitive to news. This is where we see a more volatile environment, I guess, shorter term interest environment. Not shorter term interest as in interest rates, but as in it's more like ADHD. They're going to be bullish one day, bearish the next. Bullish one day, bearish the next. Not looking to buy in to invest, only looking to buy in as a trading opportunity. Same thing with shorting. And so it'll make it a little bit more difficult. You put in the adage that during the summer months, it's usually just a disinterested type of environment because traders tend to go on vacations and whatnot, and people are trading less because they're on vacations with their family. I get it. Sure, that's expected. But that doesn't mean there can't be activity. And I truly believe that we're actually going to see more activity than you normally would see in the summertime, and it's going to be FOMC driven, and it's going to be tariff news driven. Now, scenario 2 is going to be also very dependent on tariff news. Notice that tariff news, I felt that it would just cause momentary difficulties in the markets, but will eventually just go up on the vertical path. I think scenario 2 is where we're more likely going to be in, and in turn, it makes things a little bit more hypersensitive in the marketplace moving forward, at least for the next month or two. On top of the FOMC meeting this week, let's not forget we have the G20 summit, okay? The G20 summit is going to be important. There's expectations out there in the marketplace that President Xi and President Trump are going to meet. And in fact, President Trump has said, if we do not meet at G20, you're going to expect another $325 million in tariffs on Chinese goods. Ball is in your court, Xi. But we haven't heard anything about it yet. So the markets are a bit at a standstill. I'm in the belief that there's a good chance that they don't meet. There's right now political tension in China, between China and Hong Kong, right? The extradition. Someone's going to correct me, and I'm not going to try it. But that bill's out there, and people are protesting. My friend's actually out there right now, and on his Instagram Live, the streets are flooded with protesters. So the reports have been there's only 300,000 people, but everybody else is claiming that's a total lie. That they see that there's at least 1 million, if not more. And if you saw, and I don't want to pull it up, but my friend's Instagram, X_judgment, if you want to see really cool photos, it tells a different story. It tells me that there's a massive protest. And I'm from Chicago, guys and gals. We see these protests a lot, okay? We have seen these protests a lot. And if you see these protests, you know exactly what a big one is and what isn't. Let me see. Let me pull this up here. I don't know how to go to his Instagram Live. There's got to be one. All right. Yeah, he's showing his T. How about that? That's right now. Right? Lined up everywhere, guys. These aren't small protests. They're flooding the streets, okay? They're flooding the streets. Sorry, I had the volume on, so that feedback might have come into the video. Sorry, it's a low budget production. But listen, that's hanging over in Asia right now. And so there could be a point where he's actually very busy at this moment, and it's going to be very difficult for him to meet, regardless if he wants to meet or not. I think if anything, we could have a very brief meeting with guidance towards wanting to meet later on down the road in the near future. But I don't think people are going to get what they expect. So we have to see how the market reacts to that. All right. Then scenario number 3, okay, is that not only do they remain stagnant, but they basically deny the ideology of needing, a rate hike, a rate cut, and that their words were taken out of context, that they may consider it in future meetings, but for now, they don't have any plans to move forward in that regard. And that would be what we'll consider the nightmare scenario. The nightmare scenario is when basically the FOMC denies everything and the market priced in fake news. So this brings me to the technical standpoint. So one of the big concerns that I've had here over recent sessions was the fact that we made a lower high. Okay, 794623, 794. That's close enough. Okay, so from this moment, if you notice, we went lower highs and lower lows. This could be the head, body, and leg movement. And this is potentially stage 3. Now, usually stage 3 moves are a little bit smaller. But what I want to point out is that from here to right here, okay, and I'll delete this. And the last one I'm going to circle is right there. Lower highs, lower lows so far. So in turn, if we're fitting within the context, scenario number 3 would not only maybe we see a little bit of support come in at the 200-day moving average at that teal blue line. This is the NASDAQ. Scenario number 3 from a technical standpoint means that we're more likely to head down to this range. And if we don't hit what's called a double bottom on that swing low, meaning finding buyers and support coming in at that level, the outline is that it's going to continue down to fit in with the trend lower highs and lower lows. So this is what's been important. Thursday, we had a nice update, nice little rally day, and we just stalled out at the highs. And it's because of that 50-day moving average. Now, it hasn't had much relevancy besides that point where the market was trying to close under, and when it did, it shows significant weakness at that point in the NASDAQ, right? But that also means that if we do unravel, we do have a floor in play at the 100-day moving average. That's at 76, 76, 96 in the NASDAQ. Now, if you want to relate this to the Qs, which is the ETF, I could easily put that into scenario here. It's the same exact thing. Now, I've done this as a lesson in my room, but this is what I really want to point out. I don't know what all this is. I don't know what that is. Once that breakdown took place, there was a strong rally on the ideology or the news that we may be cutting those rates. And if that turned out to be fake news, it tends to go back where the news point had started, meaning after it's made the move, it generally draws back like a magnet. There is a name that we are currently long in is T-Mobile. Now, I am going to point out here on T-Mobile, this was a big range bar on Friday. Support did come in at the 50-day moving average, but this total days range was $3.72. Normally, T-Mobile has been trading in a $1.80 range. Okay, so we basically doubled the day's trading range because of this news. But if you notice, the news wasn't verified yet. And so while it ran up to $78, it ended up closing at $74.90. It came back. Now, if you're wondering what it was a report by the New York Times that Reuters had also shared that the DOJ was more likely to consider allowing the merger to take place as long as T-Mobile and Sprint creates an environment where a fourth competitor could come into line. And so really what that means is that there's certain assets that they have to sell off for this merger to be completed, one being Boost Mobile. The beautiful thing about that is that Amazon is interested, the previous owner of Boost Mobile is interested, and there may be a third party. That third party is Charter Communications and Comcast, who have partnered up together to get into the mobile business. If you haven't heard, they were getting strong-armed by Apple. Apple's like, if you want to sell our phones, you have to guarantee a certain amount of sales. So, yeah. But like I said, if they want to become the fourth company to be a major player in the mobile industry in America and in North America, that is what they're going to have to do. They're going to have to strongly consider buying Boost from T-Mobile. So that's why I moved. But to get back to that scenario, that also means that if this was driven up on fake news, aka they're not going to do any rate cuts, that means it comes back. And it should come back just as quickly. And in turn, if it doesn't hold that level at 169.27 in the Qs, a major level that's already considered a double bottom based on this swing low here, okay, and March 8th, this was at 169.34. So it was just about the same price, okay? That means we're coming back. Maybe all the way down to that 150 range where we started from at the beginning of the year. Now, I'm not doom and gloom. I'm just saying, got to be careful. My ATR trailing style, when we talk about technical analysis, this is one of the things I'm going to outline big time, is actually on the buy side. We'll have to wait and see. We'll know once we hurdle the 50-day and extend away if we're in that breakout mode, and that's going to be in line with scenario one. We'll be going back and forth, I would say, probably till towards the very end of the month, and maybe even leaking into July because of the holiday, in scenario number two, where we just bounce back and forth, up one day, back down one day, both good and bad, maybe tight trading ranges, maybe really big volatility, we just don't know. It's that scenario number two. And scenario number three, which is the worst case scenario, is where we dump off and we actually extend, because sellers would take full-on control. We'll have to wait and see, guys and gals. I'm going to try and crank out one more before I go on vacation. I'll definitely have one once I get back. I hope you enjoyed this podcast. I hope it was informative. Again, if you're wondering what you should look up, and I'll actually have Danny, our producer, put this link in below, but you should always look up FOMC future rate cut CBOT. Futures rate cut, right? So countdown to FOMC, you'll see from the CME group, CME Fed Watch tool. Boom. Bookmark it, save it, do whatever you got to do. Remember it. It's important. Give a damn about your money. Hopefully, I outlined this scenario to make things easier for the new investors and even for the veterans that just wasn't sure how to register this information or how to guide and follow this information. Again, infotainment, but most notably, I want people to be more informed. I want them to do better for themselves, and I want them to kick some ass when they're in the markets. Ladies and gentlemen, thank you. Thank you for watching. Don't forget, like, comment. If you haven't already, subscribe, share. If you need to send me comments directly, you could do it on Twitter, Disciple of Trend. You could actually email me, ladies and gentlemen, comments, suggestions on content. Give me a stock you want to talk about. If you really want to know, leave it in the comments below what stocks we should talk about here. I'm going to be talking about Momo names and Uber very, very soon. And I'm also going to give you guys a little breakdown on some technical analysis. Not chart patterns. Actual true technical analysis that I believe the Wall Street loves to look at here. Stay tuned, folks. Thank you for the continual support. I absolutely love every single one of you that sends me the positive messages and the vibes. Guys and gals, let's see what this week is going to bring to us. Scenario 1, 2, or 3. What is in store? I'm a bull. Not a perma bull, but I'm a bull. I want to see the markets go up. How about you? Take care, everybody. Until podcast number 4. See you then.
Don't forget to like, comment, and subscribe. Also follow us on our socials, Facebook, Twitter, and YouTube. If you have any comments or questions, you can email me, podcast@prospertrading.com. Thanks, everyone.